Well, thank you all for joining our November of 2024 Landowner Insights call. We're going to talk about what's happening in the farmland market from a very sort of boots on the ground perspective with a very current kind of viewpoint. And we certainly have plenty of uncertainty and kind of changes happening in the economic landscape right now. So Hunter Norland, our Director of Acquisitions, is joining me on this call, along with Steve Bruere, the president of People's Company. And so one thing that we want to start off with really quick is kind of giving a preview of our National Land Values Report, which will get released here over the next couple weeks with a webinar that kind of goes into the details of the analytics of what's happening regionally. And this is the time of year when we're going to see a lot of these kinds of reports come out that start to aggregate data that's put out by USDA or other sort of private affiliations on what's been happening with farmland values and returns. And one thing that always happens with these releases of reports is making sure we're recognizing that they're kind of a look back into the past, right? They're a summary of information that has a little bit of age to it already. If we think about USDA's farmland value surveys, those are typically released roughly mid-August, sometimes a little bit earlier in August, and that's going to be surveys where there's quite a bit of data collected and then curated many months prior to that. And so what we're looking at here in terms of state level farmland values is really something that it was closer to the end of 2023 or potentially through the first quarter of 2024. And comparatively, what we see is just a little bit of flattening in terms of the growth. As we look across the states, a lot of these values look pretty similar to where USDA had them last year. And total returns, this is estimated for 2014, so this would be appreciation plus that cash yield. They're down through the core corn belt versus what we would look at as a 20 or 30-year average. And again, this is a little bit of a backwards look, so we need to keep that in context as we think about it. And that'll be a big part of the conversation today. What are we really seeing on the ground right now? So the year-on-year change, and if you look at, I'll call out Iowa and Illinois, those two states on a 20 to 30-year annual appreciation average are going to be in the 6 to 8% range. And you can start to see that that's clawed back, even recognizing that we're stepping back to earlier in this year. Several of the plain states have still had some pretty good runs, and this is pretty typical. When you go to the fringes of the Corn Belt, it can kind of pull along and trail some of those core Corn Belt states. And a lot of the country is functioning similar to where it has. Now, recognizing that we've had quite a run going all the way back to 2020, it's pretty interesting to look at that several year value increase. And a state like Kansas jumps out in this map in a pretty big way, is with a 66% run in farmland values. So when we look in total, and again, recognizing that this is sort of a age data set at this point, we are above trend line relative to the USDA values in each of the regions. Now, how far above trend line on a 30-year basis is a little bit different region by region, but that substantial run looking at that 2020 through 2024 data sort of represents that farmland values definitely creeped up, and it did it consistently across the country. And this created this scenario where we've had some things that were out of balance. When we think about commodity prices, land values, and interest rates, it was hard, and the market kind of locked up for a fair period of time where there just was a lot less flow of transactions. And that's where we kind of want to get into the discussion today just a little bit. And so, Hunter, I'd like to start by introducing you, or having you introduce yourself and talking just a little bit about what you're doing from a boots on the ground perspective in terms of finding farmland for investors. What's your role within People's Company Capital Markets?
Yeah, no, thanks, Dave. Appreciate you having me on. So I assist the capital markets team, mainly with land acquisitions for a lot of our investment clients. And so, my job and my role day in and day out is deal sourcing and due diligence work for all these groups, as well as some asset management on farms that we acquire. And so we would work with, high net worth individuals, institutions, family offices, and then quite a few 1031 exchange investors. And again, on a weekly basis, we build out a robust pipeline all across the country, basically from Washington to Florida and about everywhere in between, and have a pretty good team behind me helping with it. And so, again, we're reviewing deals weekly and looking for opportunistic buys for our clients.
Yeah, excellent. One of the ways to kind of frame this conversation for landowners that would be listening is asking the question, is now a good time to buy farmland if you're in the market to buy, or if you're considering it, is now a good time to sell farmland? And the reality is it's a kind of a fairly dynamic time to think about that question. And the first thing that in kind of conversation topic I'd like to dive into a little bit is this notion that the market has sort of unlocked here over, let's call it, the last 6 to 8 months. And Hunter, would you talk a little bit about what you're seeing from a deal flow perspective and just kind of how that's comparing to the, call it, 12 to 18 months prior, where things candidly felt a little expensive?
Yeah, the market dynamics right now are super interesting. I mean, I don't think there's any question that we hit a peak in land values, like you said, 18 to 24 months ago. And, a combination of that was, record low inventory levels as well. And so between those two things, it was a pretty tough market to get anything done at. Everything was going to public auction, super competitive. Land values just seemed to go up by the day. And then now here recently, we've got depressed commodity prices. We have interest rates that have now caught up, it feels like, on balance sheets and cash flows and things like that. And all of a sudden, inventory levels seem to have kind of cut loose a little bit. Now we're starting to see more opportunities than we have before. And really more of like a normalized market, it almost feels like, which feels pretty good. I mean, the land market for the most part feels like it's plateauing a little bit. I mean, you're going to see, outlier sales on both sides of that. There's no question about it. I think the days of the record highs are probably over besides specific locations and areas. But at the same time, I think there's some opportunities to buy farms, under the trend lines. And so we're tracking that pretty close. I mean, in general, we're excited. I mean, again, we just at least have some opportunities to look at and some deals to review on a weekly basis, far more than we did here in the recent past. But no, I would say we're cautiously optimistic on things, and it's been a pretty active late summer and early fall thus far, and probably throughout the end of the year.
Yeah, so staying with you, Hunter, and thinking about this buyer perspective before we kind of move into thinking about the sell side perspective, walk us through some specific circumstances where you're seeing, I think you'd say that you're able to find quality farms, maybe 10, 15, or even 20% off, where you might have seen them 18 to 24 months ago.
Yeah, no, I think that's accurate. I think what it is, it's very location specific and again, opportunistic. So I think, patient capital can find those opportunities. I'm not saying you can show up to every farmland auction in the Midwest right now and expect a bargain because that's certainly not the case, especially when you look at the data. But again, I think there's certain geographies that have either been oversold, maybe had some weather issues, perhaps are just weaker in general, where you can start to see the trend line start to tick down on land values just a little bit, and you can pick up some acres for a better price than you could before. But again, it's all location specific. One example I have is Western Illinois here just in the last week. There was a sale of multiple tracts of land that brought over $20,000 an acre, which I was the one saying a couple of weeks ago the day is a $20,000 an acre over, and then that sale happens, right? And so again, I think you've got areas where there just hasn't been many farmland transactions the past couple of years, and you've got owner operators that have been sitting on their hands waiting for the right opportunity to buy. We've had more or less record yields in the Midwest. And frankly, rates that seem to maybe be coming down, or at least there's some optimism behind that. And so I think that drives higher land values in some areas. But then again, if you ask our brokerage division on land auctions right now and how they feel, I think the conversation is pretty similar throughout, and especially talking to a lot of our referral sources as well, as if you're going to have a public auction and you don't have the existing farm tenant that's interested, perhaps the next door neighbor doesn't feel like they need to own it or doesn't want to fight over it with their other neighbor, and then you don't have a 1031 exchange investor in the room, all of a sudden I think you're going to have a pretty tough sale. And again, that's an opportunity to maybe pick up a farm at a discount, it seems.
Yeah, so Steve, thinking about the sell side and what you're seeing across the brokerage business and trying to communicate a little bit of this dynamic framing that we're living in right now with landowners that might be considering selling. How is that conversation flowing, and what kind of advice are you giving?
Yeah, I mean, you guys are hitting on all the points. I mean, a lot of the data that's out there right now is suggesting that the farmland market's softened a little bit, and so folks will ask us, "Hey, is now a good time to sell a farm?" And of course, when it's fun to sell farms when you're going to have a sale and you're going to set a record high price, and everybody's high fiving after the sale that you hit that price. And when you start to move off of that a little bit, is that still a good time to sell a farm? And my bias is that we should all never sell our farmland. We should own farmland forever because it's a great investment. But if selling is in the cards and there's a life event or a reason that you need to sell it, yeah, you probably missed the peak. It would have probably been ideal if you would have sold your farm 12, 18 months ago. But when you think about a long-term perspective, if you've missed the peak, you're still at really strong record prices in many ways, and it's still a good time relative to the dynamic that would require you to need to sell that farm to let it go today. So it's a little bit of a political answer in that is now a good time to buy a farm, and that was where Hunter was headed. I think from a buy perspective, you actually get kind of excited right now because the market's becoming more rational. Prices have pulled off of those record high prices. Buyers aren't chasing farms. So if you're a buyer right now, you're able to get value. You're able to buy at a price where you don't feel like the market's completely irrational. But at the same time, if you're a seller and you've got the right dynamic, as Hunter's mentioned, there still is a lot of investor capital out there right now that wants to buy farmland. If you're a well-capitalized farmer in a community that a lot of farms don't come up for sale, those folks are still stepping up to the plate. Hunter mentioned that Illinois sale last week that was really strong. There was a super strong sale up in South Dakota this week, over 20,000 an acre. There's been some really strong sales in Iowa. And so I think you've got to know what kind of asset you've got and what kind of neighborhood you're in and who the buyer pool is, and it can be both a good time to buy and a good time to sell.
Yeah, so that's a nice lead in to kind of breaking the country down with some regional perspective just a little bit. And Hunter, I'll keep pushing you on some specific examples in different regions that you're seeing and that we're working on. And obviously we've talked a fair bit about the Midwest, and the Midwest does tend to be on the front edge of these farmland value curves as they can move up and level off over time. I think one of the big themes that's jumping out, and Hunter, I'll turn this over to you, is that the quality of the farm and the neighborhood that the farm's in relative to the Midwest, on whether you still have some of these triggers for some very high values. Is that kind of where you're at?
Yeah, no, absolutely. I mean, I think, like you said, broad strokes, we've been Midwest focused here just because that's where we're at. And so it's easy to talk about. But again, slightly off the high, but, I think that land market's plateauing a little bit with inventory levels, slowly increasing or at least normalizing. Now, regionally, though, when you look at different areas we work in, say the Pacific Northwest, for instance, Idaho, Washington, Oregon, I think there's still a huge lack of inventory there. And I mean, there's just, very little deal flow coming across the desk out there. Can't shake a farm loose. I mean, if you had $50 million or even $10 million you wanted to place in Columbia River Basin spud farms, you'd struggle to do that for the next, throughout the end of the year, I think, because we've been trying to do it right. And I think that's propped up values quite a bit out there. I know there's a little uncertainty with spud pricing, but I also think that harvest went well, and there's a lot of optimism out there at the same time. And so, again, you're in a very strong market there where there's just very little inventory, and I would say that market's almost increasing in value, it seems like, or at least haven't seen a decline. Now, you move south to California in the West Coast, and complete opposite. There's obviously a lot of distress with what that pricing's done the last couple of years, and with Sigma and everything else that's going on out there with the irrigation dynamics. And, there's record levels of inventory. I mean, I think there's areas that you couldn't give a farm away, it almost seems like. And so, again, very regional specific, but I think it just changes throughout. We do a lot of work down the Delta, Arkansas, Mississippi, Louisiana, and I think that area is kind of clipping along. I don't think there's been too many ups, too many downs. I don't think there's a lack of, opportunities available. I don't think that there's too many. It's just been kind of, leveled out and kind of just business as usual, it seems like. But at the same time, we've seen, some opportunities to capitalize on a few different farms that we would consider Class A at prices that are probably a little less than what they've been the last couple of years. And so, again, super regional specific, but I think inventory is fairly key. And then, location is obviously key as far as what the weather's been, what yields have been, and what just the local outlook is as far as optimism or pessimism as well.
Yeah, let's get a little more specific on some of these regions. So if we talk about the Pacific West and we think about California specifically, obviously any asset acquisition in California is going to have a huge sort of variance depending on the quality of the water. And I think what we're seeing, certainly, and we know that the tree nut space in particular has had some real cash flow challenges here over the last 5 years. But Hunter, I think what we're seeing in very specific terms is the best quality water and solid quality assets are actually still a little bit harder to get into, and the market's really heavily flooded with the assets that fit into that lower quality tier, where it's going to be a little bit more of a price run from a commodity standpoint before you start to get into the positive cash flows. Is that kind of accurate?
Absolutely. Yeah. No, I would say quality is king when it comes to that.
Yeah, then moving up into the Pacific Northwest, certainly it's a region that we've really enjoyed working in quite a bit. And what have you been able to find up there? I think maybe there's a little bit of movement in the wheat space where we see a little bit of commodity pressure. But you mentioned inventories being really light on the irrigated assets, but what are some specific examples of assets or opportunities or production systems where you're seeing at least something that you can work with?
Yeah, I would say probably on the dryland front, obviously we love the Palouse and the Class A farms out there and the best wheat producing region in the U.S. and frankly the world. But again, that's a very tightly held area with some of the best quality farmland in the Pacific Northwest. So it's hard to shake anything loose. But the B quality areas, maybe the slightly lower rainfall areas, you're seeing inventory levels start to increase just a little bit. So we're seeing some opportunities there and really enjoying those. And then it's still on the irrigated side, right? I mean, I just think that quality is everything, and we're seeing a few things here and there, but gosh, it's tough to name your price, right? When you've just got such a competitive market out there on the irrigated side, there's only so much land available out there to grow spuds and onions and name your crop. And so the dryland, we've seen a little more activity on the dryland front, I guess. Long story short.
Yeah, I think it's safe to say that the core thesis that the value of water in the Pacific Northwest is still a little bit undervalued in a broad context, and there's going to be more growth, I think, still holds. Hunter, we've also got a couple of deals closed and in the portfolio with some of our capital sources down in the Delta. What's been the trigger for having some opportunity to get good solid deals done down there?
Yeah, I think again, it's just timing of the year, right? I mean, I think number one, you're just seeing opportunities for that folks want to, sell farms and close out by year end. So that always seems to trigger a little bit of uptick in inventory levels. And then, Steve might be able to speak to this a little bit, but I think what we've seen on the institutional front is that some of these funds and other institutions are starting to roll out of some of their assets. Maybe they've hit their, investment horizon on a 10-year fund, for an example, and they're looking to just sell their farms and roll into a new fund. And I think the time of year right now, plus just the year that we're in, we've seen that start to happen this year and into next year, and that's where I think some of these inventory levels have increased as well.
Yeah, absolutely. So let's cycle back to the Midwest. We've gotten some deals closed in the Midwest here, quite a few actually over the past 3-4 months, and we've had the quality conversation, trying to understand exactly how the highest quality stuff with a lot of competition, but we've gotten some pretty good quality assets closed as well. Do you have any sort of unique stories on how we've been able to maneuver into getting good quality assets at price points that make sense? It's kind of being integrated into the market really deeply as much as anything else, right?
100%. Yeah, I would say between, obviously our existing tenant base we work with, who's a great referral source on deal flow for us, but as well as just our referral sources, right? Brokers and attorneys and CPAs and lenders and that kind of thing. And we, again, like I mentioned, we had a very active end of summer into early fall. And what triggered that, I believe, was obviously, the commodity prices decreasing fairly rapidly. I think more than what folks thought right before harvest. And so you had a time frame there in July and into August where all of a sudden we saw, $4 bushel corn or sub $4 bushel corn. And that was something we hadn't seen in a while. And I think it shell shocked the market a little bit. I think all of a sudden you had some auctions that were booked that, folks didn't show up to just because they didn't know what their yields were yet. They didn't know what commodity prices were going to do. And some folks struggled there. I mean, we had a time period here in the Midwest that there was actually more no-sale auctions than we had seen since probably 2020. I would say was the last time we saw something like that. And we picked up the pieces after a few of them were able to negotiate favorable deals, in my opinion. And I would say we got definitely more than a handful of farms bought just in that 2 or 3 month period, as everyone was kind of recalibrate to what the commodity market had done, and then figure out kind of what their cash flow outlook looked like on yields. And all of a sudden, everyone got in the fields, and yields were promising, and commodity prices came back a little bit, and again, the market normalized. But again, there was probably a 2 month period there where we took advantage, and then we had a really active time getting some farms acquired.
Yeah, and so that kind of leads us right into starting to think about how farmland buyers and the capital sources are really looking at farmland right now. And going back to the period where we had our inflationary run, we had really high fixed income rates. There was certainly folks that we talked to that wanted to see what was going to happen politically, and wanting to have more information in terms of trying to find the trigger and getting back in. Steve, you spend quite a bit of time making sure you've got a good read on how capital is viewing farmland. What are some key themes that are jumping out to you right now?
Yeah, you talked about the market being unlocked, and I would say for a good chunk of 2024 and into the fall of 2023, that land market really kind of locked up, because as the cost of capital went up, where borrowing costs were, above 8% in some cases for farmland loans, farmers didn't want to borrow money, investors didn't want to borrow money, and you really were locked into just cash buyers in the market at that point. And transactionally for People's Company, our transactional volume just kind of hit the skids there, because buyers didn't want to buy and sellers were fearful of bringing their farm to the market. And so now that it feels like we've gotten control of inflation, and interest rates have leveled off and came down, that unlock of the market has really become evident. So transactionally, our transaction volume has picked up substantially now that these interest rates have leveled off. But it's quite interesting if you watch the 10-year Treasury yield, and a lot of times when you think about farmland values, people think about farmland relative to what the 10-year Treasury yield is. And as the Federal Reserve had their 50 basis point rate cut, and then they had their 25 basis point rate cut, you would think that your 10-year Treasury yield would have gone down. But over the last 2 months, your 10-year Treasury yield's gone up about 80 basis points. And so that makes borrowing costs for farmland more challenging. And so, I actually felt better in some ways about where the market was 30, 60 days ago than I do today, because now you're starting to get some fear built into the market of higher interest rates again. And when you really start to talk to some of these folks that we get to interact with, what I call kind of the smart money folks out there, you're getting some fears of inflation again. And so even though it feels like we've got inflation under control and interest rates are coming down, as you watch that 10-year Treasury yield move up, that's a signal that the financial markets think that there's inflation ahead. And I don't know if you've got any of those inflation charts, Dave, in your slides, But you've got kind of two competing forces here. And I've always said that inflation's good for farmland because farmland and inflation are perfectly correlated. When you look at farmland over a chart of inflation, they're positively correlated since the beginning of time. And so on one hand, you kind of feel like you're talking out both sides of your mouth here, because if the smart money, as I call it, thinks that we're going to have inflation and that's going to rear its head, then inflation and farmland are positively correlated. That's a positive for farmland. But inflation's good until it gets to a point where your cost of capital becomes prohibitive to borrow money to buy farmland. And so as these interest rates move back up, that becomes a headwind or a negative for farmland. And so we're kind of in that weird spot right now where it's not completely clear that inflation's under control, and it's not completely clear that interest rates are going to continue to come down. And, I'm even hearing, the December rate cut of 25 basis points may or may not happen now because of this fear of inflation again. So there's a little bit of moving around, and it's not settled out, and it's not clear to me which way the market's going to go yet.
So another thing that we've certainly had pop out in a lot of conversations with the capital that we're working with is the notion that the public equities are due for some correction, right? We've seen a lot of public equity investments with some incredible runs, and we've had a few of those phone calls that, hey, I'm not trusting those markets. I'd like to get into something a little bit more long-term stable, like farmland, and that's driving some things and unlocking some more capital. And Hunter, I want to flip back to you a little bit. Some of the capital sources that we're working and sourcing for, we have seen a little bit of a movement in terms of maybe rethinking where they need to be on cash yield, even if they're long-term hold kinds of folks. And we've had some folks kind of request, hey, we'd like to maybe think about farmland on a little bit of a higher cash yield basis, and that kind of tracks back to where you can find opportunities a little bit. But that's been kind of one of the elements you needed to sort through here over the past few months, right?
Yeah, the cash yield conversation is always interesting, right? I mean, I think first and foremost that we've gotten our heads wrapped around buying the best quality farmland in the best quality areas, and as long as you're buying right, not overpaying and trying to buy below trend line, it kind of figures itself out before you even worry about the cash yield. Now, with that said, cash yields, if you start chasing them, you start sacrificing quality, it feels like. And, we've had a little bit of a decline in land values, which would indicate that the cash yield should increase. But with that said, we've also had a decline in commodity markets. And so all of a sudden your rents have been compressed slightly. Now, the opposite of that is that, we manage a lot of Class A farms that we've acquired the last few years. And generally speaking, I think a lot of our lease rates have remained fairly steady. And I think that was, number one, because I feel like we were negotiated a fair lease structure that includes, some flexes that are favorable to both the tenant and the landowner. And so, you don't have to keep renegotiating leases, even with changes in the commodity markets and with changes in land values. But yeah, generally speaking, a lot of our capital partners are starting to rethink, hey, where do we want to be as far as, cash yields and annualized returns go? And it's a conversation to have, right? I mean, when I say splitting hairs, I don't know if, changing your return threshold by 25 basis points really makes a difference on a 10-year hold or 30-year hold even. And it's easy to do, but if you start talking 50 basis points, then all of a sudden you might find yourself sitting on the sidelines with a lot of other folks thinking that this market's going to continue to dip and that cap rates are all of a sudden going to open up, which I don't know if we fully believe will happen.
Yes, that's right.
I would maybe jump in on that, Hunter, because I think that's key. Some of these farms that you've been getting bought were maybe farms that were $18,000 an acre 18 months ago, and you're getting them bought for $16,000 an acre today. And to your point, your entry point is less, but your cap rate hasn't gone up necessarily because your rents have pulled back a little bit as well. And so what we're seeing is, and this comes back to those comments I made earlier about the market being rational. I think the outside investors who maybe wanted farmland as an inflation hedge a couple of years ago were sitting there looking at farmland at $18,000 an acre and saying, gosh, I can go get a T-bill or put it in a money market account and get a 5% return. Why would I go buy farmland at 18 and get a 2.5% return when I can have it in a safe place that's liquid over here? now that you're seeing that rationalization in the market come back, where maybe that 18, 16, your cap rate hasn't gone up, but your risk of values sliding further from 18 to 16, from 16 to 14, that risk is minimized substantially. And that's where I think we're seeing a lot of people get excited about jumping into the market at this $16,000 level in that example. And while the cap rate hasn't increased, the entry point of the assets came down quite a bit. And this goes back to the 20-year appreciation rate. In Iowa, your 20-year appreciation rate's in that 7 to 8% range, and that cash yield at 2.5%. If you've got 8 on the appreciation, 2.5 on the cash, you've got a 10.5% total return. And all of a sudden, that looks really desirable compared to a T-bill that maybe has now got a 4 in front of it instead of a 5 in front of it. And that's where I think that we're seeing some of the capital come back into the market now, because the land market is more rational.
Plus, we've got the inflation hedge story. We have new revenue coming in. We've spent quite a bit of time talking and making sure we understand how energy infrastructure, data center infrastructure, and one of the elements that we'll continue to talk about and really try and uncover a little bit more is emerging concepts in the whole ecosystem service market, right? So to your point, Steve, the base performance is what it is, and we can understand that pretty well. Plus the farmland market, you get to stack in some of these other externalities driving return as well. Let's flip over and talk a little bit about opportunities. Hunter, you brought up earlier around there's a fair bit of institutional capital that's coming to an end of life on their funds. Steve, you've got a really good handle on where those folks are at, how they're thinking about things. What kind of rural opportunity do you see there, just relative to some of these institutional folks, or even typical farmland funds that might be approaching that end of term?
Yeah, I mean, really what you're seeing is that there's a lot of the asset managers that were actively out acquiring assets over the last 10 years when interest rates were effectively zero. They were able to put a lot of capital into farmland and raise a lot of capital for their farm funds. And as they've come to the end of life, what you really want to, on their fund, what you really want to do is raise money for the next fund as you're returning capital to your investors. But those investors that had been piling in before now have more alternatives and higher return alternatives than maybe some of the cash yields that they were getting on farmland. And so it's become harder for some of these groups to raise capital and launch their next farmland fund. So if you get into some of these neighborhoods that were dominated by not farmers, but more investor types or asset managers, and now instead of being a buyer, they're actually selling assets and liquidating assets to return capital to their investors, all of a sudden that has a pretty profound impact on a market where they were acquiring and now they're selling. And so you're starting to see some opportunities there to pick up some assets as there's less competition in some of these neighborhoods.
Yeah, absolutely. Hunter, I want to put you on the spot a little bit. Like, when you think about a 6 to 12 month kind of time frame, you've got to have a couple of nuggets in your back pocket of things that are particularly interesting. What can you share with us?
Oh, I don't know if I have much particularly interesting, but I think I'll say it again that we're cautiously optimistic, right? I mean, I feel like we've got a land market that's starting to stabilize a little bit. We're recalibrating to that, no doubt, and we're doing it by the day, it seems like. But I would say with these increased inventory levels, we're able to pick and choose a little bit, right? I mean, that's something that we actually haven't had the ability to do the last couple of years. If a farm hit the market, it got 5 offers in one day and everything had to be done in 24 hours, right? I mean, that just wasn't normal, wasn't rational. And now all of a sudden you can start to, play the game a little bit, negotiate, put some bids out there, put some offers out there, be strategic, be patient, opportunistic. We can watch these auctions, see how they're doing, pay attention to the local land markets a little more, and kind of get our feet under us a little bit. And again, we're trying to take more of a rifle approach than a shotgun approach, is what I say, especially with our increased deal flow. I tell everyone that, in our weekly pipeline meetings, we're probably reviewing, and then this could be a little bit of an exaggeration, but 50 to 60 different opportunities across the country a week. And when we do that, we really have to start to funnel down, what's the most actionable opportunity that we can spend time and resources on, and makes the most sense for our client, for our team, and for everyone involved. And so that's where, I'm excited. Again, I don't think we're going to sit on the sidelines, because I think if you're going to do that, you'll be sitting there for a long time trying to get a farm bought. But we're also not showing up to every auction the next, 2 weeks and raising our hand trying to buy everything either. So again, we're seeing everything. We're just trying to recalibrate and make do with what we got, and pay pretty close attention to the market and see if there's any signals on if the markets should go up, should go down. We're talking to our tenants all the time, talking to our referral sources, and just trying to make the best decision with what we got.
I'm going to keep trying to force you to give me some sort of insider info. Let me just ask you this one. What region of the country do you think you're going to close the most farms on in the next 6 to 12 months?
Oh, I'd say Midwest probably.
Okay, so that's at least a little bit of a nugget on how you're feeling about the many, many dozens of deals across all the regions that you see on a weekly basis. So, Hunter, one of the opportunities, it seems like that it's emerging at a reasonably rapid pace, is the sale leaseback opportunities. What are you seeing there?
Yeah, no, that's a good question. That's an interesting trend that we're starting to see a little uptick in, and an increased deal flow on, for sure. And I think there's a few different dynamics with that. Broadly speaking, I think we're seeing that across the country. It doesn't really matter what region you're in. I think a combination of that is maybe a decrease or a limit in working capital versus what it was maybe a couple years ago, and also the cost of capital, right? That we've discussed, and we'll probably talk more on. And we have situations where we might have an owner operator or a current tenant that comes to us, and it's more of a strategic decision. It's not a have to, but a want to, right? Maybe a farm has come up next door that they'd like to purchase, or maybe it's family ground that they're looking to buy out. And it's the decision of, I'd rather sell the farm that's 10, 15, 20 miles down the road that I'm not married to, but I'd like to continue to operate and pull that capital out of that, and then buy something closer to home, which we've got a lot of those situations working right now. All the way down to maybe some more distressed situations, right? Maybe there's some bank pressure, maybe these rates, cost of capital, et cetera, have kind of caught up the last couple of years. I think what also happened was this commodity market, obviously, with the decrease in commodity prices, came at a time when I think a lot of grain bins in the Midwest were being cleaned out. And all of a sudden, a lot of corn that should have been sold with a 5 in front of it was sold with a 4 in front of it. And you take that across, a large scale of acres, and that can, have a pretty diminishing effect. And so the sale leaseback trend will continue. That is one thing we anticipate. And we're prepped and geared for it. We're developing some programs around that to assist different folks with it. And again, it's just another part of deal flow. And again, I'm not too pessimistic on it. I don't think it's a trigger for concern. I just think it's a natural occurrence with the market we're having. And again, it's more strategic in nature than anything, and probably the smart thing to do when you look at the numbers and compare different options. And so, no, again, I think sale leasebacks will continue, and we're excited to help folks out with that.
We want to close it out just a little bit with a few nuggets that we'll develop quite a bit more through our national land values release and discussion, and then going into the Land Investment Expo in January. To some extent, we actually need to see what happens, but some of the uncertainty, right? Some of the drivers that we can kind of see hanging out there, but we don't necessarily have really strong information about just yet, right? So we mentioned a little bit that there is some changing sentiment on equity markets. Again, it's feeling pretty expensive. We're kind of bouncing around, and this is going to impact the capital perspective, certainly, and where farmland plays in a lot of really high-end portfolios. The policy side of it is really interesting. And you can swing quite a long way across the spectrum on the sets of positive and negatives from a policy standpoint with everything that's changing right now. Everybody is certainly in commodity ag is thinking about trade and tariffs, right? And how that plays into the commodity price environment. It'll be interesting to see what kind of lame duck session progress gets made on the Farm Bill and how that fits into some of the conservation funding. What's going to happen with renewables? And then from a broad ecosystem, system standpoint, what Steve talked quite a bit about inflation and what's the cost of capital really going to look like as we go forward? Steve, do you have any interesting nuggets that you want to throw in on the policy discussion?
Yeah, I think you've got a new farm bill that's going to likely emerge here in 2025, and there's a lot of moving parts, as you suggested, with renewables and a new administration and how they're going to set policy around the carbon pipeline, as an example, wind and solar, and a lot of dollars that were directed into those renewable opportunities under the Inflation Reduction Act, and how much of that is going to look different. After the election, next day, all the stocks were up with the exception of renewable energy stocks. They were down and commodity prices were down because of the fear of tariffs and whatnot. So I think the jury's still out on how this is all going to play out, and there is some risk there right now that some of these major moves that look like could happen in the next administration, while maybe they're good for the country in some ways, but they may not be good for agriculture in other ways. And so it is going to be really interesting to watch how these policy impacts impact farmland. And I've always said, farmland values, for farmland values to have a 1980s environment where they came down substantially, it would take a fundamental change in policy. Well, this is the type of environment where you could have that fundamental change in policy, whether it's a change in renewable fuels, or it's a change in tax code, or it's a change in crop insurance in the farm bill. You just don't know where it would come from. But there's definitely some black swan events on the horizon that could impact ag.
Yeah, I know, Steve, you and I have both had quite a few conversations with our peers and colleagues across the farmland space and the ag space more generally. There's a lot of folks trying to think through and sort through what could happen and what it could mean. And the reality is we just need a little bit more information before we're going to be able to dial it in. And we are going to talk a little bit through the National Land Values Report this year, and then moving forward into the Land Expo and early into next year on some kind of interesting new constructs that are emerging around ecosystem services. And certainly carbon has been one of the key potential revenue sources that a lot of business models have attempted to pull off relative to farmland. We think there's some really interesting investable structures emerging there that we'll talk about just a little bit more as well. So with that, I think we've taken enough of everybody's time today. Thank you, Steve and Hunter, for joining, and encourage everybody to keep an eye out for the National Land Values Report here over the next couple of weeks, and the follow-on webinar kind of rolling out what really emerged through that report. And then we'll be in touch with many of you, making sure that you have all opportunities to get to the Land Investment Expo coming up in January. So thank you, everybody, and we'll talk to you again soon.